Hello class, welcome to Chapter 11, Accounting Periods and Methods. Learning objectives for this chapter will be to explain the rules for adopting and changing an accounting period, explain the difference between cash, accrual, and hybrid accounting, determine what costs must be included in inventory, identify the amounts of incomes to be reported from serial accounting methods, compute the amounts of imputed interest in certain transactions, determine the tax treatment that results from changes in accounting methods, describe tax planning considerations for accounting periods and methods, describe compliance and procedure considerations for accounting periods and methods. Accounting methods governs what year the taxpayer's income and expenses are recognized. The tax accounting methods must be generally the same as a taxpayer's financial accounting method. So you should not have a calendar year for your financials and a fiscal year for your tax return. They're normally the same, especially when you're having financial statements. You want them all to be lined up. Accounting methods, you have the 52, 53 week year, you have the fiscal year, and you have a calendar year. Selection of the tax year, you have C Corps may select a tax year that best represents their business cycle. Generally, S Corps, partnerships, and personal service corps must use a calendar year. The exception, they may elect under Section 444 a tax year that results in a tax deferral of 3 months or less. For changes during the accounting period, generally you cannot change the accounting period without the IRS written permission. You need to have substantial business purpose and file election. IRS permission request on the Form 1128. If short period results because of the change, then must annualize your income and calculate tax. Then taxpayers pays pro rata share of tax liability during the short period. The exceptions, you do not need IRS permission if newly married taxpayer changes year to conform with spouse, changes to 52, 53 weeks within the same calendar month. All 4 criteria must be met. No change in 10 years, no NOLs as a result of a change, short in taxable income must be less than or equal to 90% of the prior year taxable income, and no change in the entity status. Overall accounting methods, you have the cash, you have the accrual, and hybrid. For the cash method, new taxpayers can generally pick in any accounting method. However, cash methods only available to taxpayers who meet the following. Gross receipts are less than $26 million if there's cost of goods sold, COGS. If there's no COGS, then taxpayer can use the cash method regardless of size. Most of the time, individuals are on the cash basis. Taxpayer can use different accounting methods for different lines of business. Cash basis taxpayers must recognize as income any money or property actually or constructively received. Property is valued at fair market value on the date of transfer, must capitalize and depreciate fixed assets. Prepaid expenses must be capitalized and amortized as goods or services are used if life of the asset extends substantially beyond the end of the tax year. That's the 1-year rule. No 1-year rule available for prepaid interest expense unless the amounts of points paid on the mortgage to purchase or to improve a personal residence. Checks and credit cards equal cash payment. Taxpayer's note is not equivalent to cash payment. Therefore, no deduction until note is paid. The accrual method, that's when the income is recognized when earned. So the example, when goods and services have been provided. All events test earned is all events have occurred to fix the right to receive the income, and the amounts can be determined with reasonable accuracy. The exception is prepaid income is recognized when received. The exception to an exception can defer recognition for prepayment of goods if tax accounting equals financial accounting. can defer recognition if prepaid for services, must recognize revenue associated with services provided in year 1, remainder must be recognized in year 2, irrespective of whether services are provided. For the deductions under the accrual method, you can deduct only if they both meet all events test and economic performance test. The all events test, you can deduct if all events have occurred to establish the fact of the liability and amount of expense can be determined with reasonable accuracy. The economic performance test occurs when property or services are actually provided by the taxpayer or the other party. Deemed occurrence of economic performance, all must occur. So you have all events must occur without regard to economic performance. The economic performance has occurred within 8.5 months. Item is recurring and treated as incurred in year of economic performance. Taxpayer is not a tax shelter. Item not material or earlier accrual of item results in better matching. Inventories. Generally must use the accrual method if taxpayers sells inventory. Certain indirect costs, purchasing agent, warehouse, administrative costs must be allocated to cost of inventory because of the UNICAP rules, Section 263A. UNICAP applies to taxpayers with gross receipts of less than $26 million. The UNICAP is the overhead included in inventory. So you have factory repairs, utilities, rent, insurance, depreciation, factory administration, and office salaries related to production, taxes, quality control and inspection, rework, scrap and spoilage, retirement plans, service support such as purchasing and warehousing. The different inventory methods, you have LIFO, specific ID, FIFO, average cost, low of cost or market. Long-term contracts include multi-year construction and manufacturing contracts in building unique property. Does not include contract for services or property normally carried in finished goods inventory. Counting methods for long-term contracts, you have the percentage of completion, a modified percentage of completion, or completed contract. Costs related to long-term contract rules, you're going to have direct costs and you have allocated overhead. Long-term contract costs, direct and allocated overhead are allocated to the contract. Costs not associated with a specific contract are deducted currently. Example, selling, marketing, advertising expenses. Interest expense must be capitalized to real or long-lived property or property requiring less than 2 years. 1 year if cost is less than $1 million to produce. Under completed contract method, costs are capitalized and deducted from revenues when the contract is completed. This is irrespective of any cash advances. Costs are placed in work in progress until deducted. Long-term contract costs. Under percentage of completion method, income is reported as work progresses. The formula is revenue recognition equals the contract price times the current year costs divided by the expected total costs. Look back interest. Certain contracts that are greater than or equal to 1% of taxpayers' average gross receipts for 3 years require a look back to compare the estimated amounts recognized in income versus actual. Contract needs to take more than 2 years to complete. If actual is greater than what was recognized, then the taxpayer pays interest on the tax that should have been paid. If the actual is less than what was recognized, the taxpayer receives interest on tax that was overpaid. Taxpayer can elect the de minimis exception, which applies to all contracts completed within a year. If reported income on a particular contract is within 10% of actual income, then there's no interest will be charged. Installment sales method, section 453, compute the gross profit from the sale, determine the contract price, compute the gross profit percentage, compute the gain to be reported in the year of sale, compute gain to be reported in subsequent years. Here is the 6252, and this is the forms for your installment sales method. Installment sales, the note is disposed of by the sale or distribution, then recognize gain divided by loss, which equals the fair market value minus gain or loss, not divided by gain or loss, which equals the fair market value less than the adjusted grosses basis. If noted gift, then gain loss equals face value less the adjusted basis. If property is repossessed, the gain loss will equal the fair market value of property less the adjusted basis of any remaining obligations. If taxpayer borrows money with an installment note as collateral, then the note is treated as being sold for amount of loan. Gain loss will be recognized. If property is sold to a related party in exchange for an installment note, the gain is accelerated when the related party sells the property to a third party. Installment sale cannot be used for penalties on properties. Installment sale cannot be used for properties sold at a loss. Taxpayer can also elect out of the installment method. If property is sold in exchange for an installment note, there must be adequate interest charged or interest will be imputed to seller. Stated interest needs to be greater or equal to 100% of applicable federal rate, the AFR, or 110% AFR if sales leaseback. Generally, imputed interest is reported as it accrues. Exceptions exist. Other imputed interest situations, you have gift loans, shareholder loans, compensation-related loans, other tax avoidance loans. Issues in changing accounting methods, determining the amount of change, reporting the amount of change, obtaining IRS consent. This concludes Chapter 11. Thank you.